Paytm. First rates, it will be a lot of red on the screen today, so that that is going to diminish all the recovery what we saw in the second half of trade yesterday. So it's across the board actually. IT would be the first one. I think Nasdaq is down 2%. That means IT is going to be down. Without even looking at it, I can say. Let's look at IT. Down 2% the index. Infosys, TCS, Wipro, LT Mindtree, Tech Mahindra, HCL Tech. Everything is down. Now let's look at PSUs, PFC, REC, the entire BHEL, railway stocks, and then let's not lose sight of Paytm.
Payments by the central bank. Manappuram gaps down about nearly 3% in trade. Couple of other weak numbers, not just ZLEC, Nikuj flagged off, but MTAR Technologies as well. The net profit has seen a sizable dip. It's a downtick of nearly 67%. MTAR should be gapping down as we speak, 10.5%. That's a severe damage on this particular stock. Sula as well, the numbers have been weak there, so look out for that too. While most of the Adani Group names have seen a Moody's upgrade in terms of their rating, and Jefferies as well has initiated a buy on Adani Enterprises with a target price of 3,800. Enterprises holding up 1.25% in an otherwise weak market. What is Nalco up to? That's where the surprise has come in terms of earnings, and a positive one at that. A straight gap up move of 3.5% is what you're seeing on Nalco right now. A lot of other numbers, and let me read down the week list. There's Oil India, Gujarat Gas, Hindustan Copper. All these numbers have actually disappointed, and you can see red shades come in on most of these names. For Gujarat Gas, actually, it's quite a steep reaction. It's down 8% right now, after their EBITDA fell about 19%, and the volumes as well were below what the estimated average was. For Hindustan Copper as well, weak numbers. For Prestige Estates as well, there's been an EBITDA slip of 4%. The revenue has come in lower by 22.5%, 5.25% of a slash coming in for an otherwise extremely buoyant sector, that's real estate. But Prestige has fallen short of market expectations in terms of their numbers. Dredging Corp, HOEC, RCF, all a list of weak numbers coming in. RailTel, by the way, has bagged an order worth about 140 crore rupees from Prasar Bharati Broadcasting. So look at that. 1.5% higher for RailTel. The Sequence Scientific, which has come out with a decent set of numbers. Eris Life, earlier today, Somit was just flagging off. There's an acquisition. The numbers are decent. 0.5% higher for Eris Life. Deepak Nitrite has delivered decent numbers. I mean, it's not been such a fall as its other counterparts have seen. IRCTC, tourism revenue has come in higher by 37%. That stock's still lower. NBCC, Nalco, BEL, which has bagged an order from the Indian Navy in excess of 2,000 odd crore rupees. All of these stocks in focus. NBCC is a very smart mover this morning, 5% higher after its earnings came out. Kunal, not such damage, one would say, looking at the global screen. I mean, 0.7% lower is pretty much par for the course.
Yeah, pretty much. In fact, on the screen also, there are a lot of stocks which are showing intraday recovery. So they may have opened with a severe kind of a cut for themselves. Opening stock, I would still back the large cap IT stocks, because my sense is these large cap IT names are going through a much more stronger positional uptrend. So HCL Tech is something which I'll be bullish on from current levels.
Okay, Naresh, let's get in a sense as to how you're reading into the market right now.
So, not a bad take as such given the market conditions. So, continue to like SBI on dips. So, looking out for SBI on dips going forward.
SBI on dips going forward. Ashwini Agarwal joins us. Ashwini, good morning. Thank you for joining us. Everyone is actually happy that the correction has kicked in. At least the bubble and the euphoria which got created, that in a sense will be contained.
Yeah, morning, Nikunj. I completely agree with you. I think, there were a lot of excesses building up in the market, especially if you looked at the valuations of several government-owned companies, or you looked at the valuations of several small caps. And if you also look at the earnings, the way the earnings have played out during the December quarter, I think the hopes were running significantly ahead of what has been delivered. So putting all of this together, I think it's good that a small correction is setting in. My personal view is that it should go a little bit deeper. That's what I think, but let's see how this plays out.
So Ashwini, I'll talk about PSUs, and
yes.
PSUs are the leader of this bull market. But is the leadership now coming at the cost of risky valuations?
Because I would like to think so. See, principally what happens is that public sector companies, they have certain inherent inbuilt in a PSU than it would be for a private sector. So to expect that PSUs will operate with the same efficiency as a private sector is a little bit of a stretch, in my personal opinion. Second is, if you just sift through how some of these stocks have done relative to the others, and if you were to look at some of the number 4, number 5 PSU banks versus the market leader, the price action suggests to me that it is highly speculative as compared to something driven totally by fundamentals. And that's something that I would say is true even for a whole host of smaller PSUs where the free float is fairly small. So I think there is a significant amount of froth in the public sector enterprise system. There might be some leaders which are still reasonably priced, but I think by and large it is my opinion that the public sector enterprise as a whole is quite expensive as a stock universe.
Ashwini, not an apple-to-apple comparison, morning firstly, but wanted to understand, what sort of an aftertaste does the market get after incidents like, say, last year, what happened with the Adani Group, with the Hindenburg case, and now with Paytm? I mean, after these serious, now that they're facing a serious risk of customer exodus after, RBI putting curbs on their payments bank.
Morning, Aisha. Aisha, accidents are a part of the marketplace. So, if you zoom out and think about the last 20 years, there have been so many situations. You had the MS Shoes scandal, you had various other companies that went incident, for example, completely rattle investors. It's obviously painful for those there who own it, but by and large, if you are running a diversified portfolio as an individual or as a fund manager, whichever may be the case, the damage to the aggregate portfolio should be fairly limited. I think booms and busts, they all produce extraordinary gains and extraordinary losses. And I think this is part and parcel of it. I don't think it damages the underlying story for India or the global sentiment on India in any way. I think that's how I look at it. So it's not such a big deal in my personal opinion.
Ashwini, hi, morning. Given that the expectations are riding high, that the overall capex theme is really going to boom owing to the fact that it's also election year, what's your sense when it comes to this entire pocket?
I have been waiting for the private sector capex to kick in, and that hasn't really happened in a big way. And if you look at the interim budget numbers, while the government has continued to allocate money towards capex in favor of, in comparison with consumption-led expenditure, I think the impulse factor is lower. By impulse, what I mean is year-on-year change in terms of how much money is going into government capex. Also, if you look at the liquidity situation, it is tight because the government hasn't spent a lot of the money over last year. So while there is capex that's going on, I think the pace is slower than what was envisaged. And I think going ahead, also the government would like the private sector to step in, and that is, I think, lower than expected at this point in time. Is how I think about it. In the meanwhile, if you look at it, the stocks have moved up. Everything's rallied. Valuations in certain cases are completely completely crazy. I mean, 60, 70, 80 times or 30, 40 times for construction companies. I mean, I don't think that that these valuations are sustainable. We have to remember that capex-led plays are inherently cyclical. So there are deep cycles, and you have 3-4 years of boom followed by 3-4 years of losses. So you have to pay a lower P multiple for peak earnings, and you have to buy them when the chips are down. So I think one has to be careful here as well.
Would you say that now it's time to, let's say, raise 10-15% cash, sit on cash levels which are disproportionately higher than what you've run in a long time? Why are you smiling on
cash position as we speak, and I will continue to do so. I think markets are expensive. I expect a reasonable amount of consolidation, maybe a deeper correction. I don't know which one it will be, time correction or price correction, but one of them has to happen. I think if I look out on 2024 as a year, I'd be very happy with market going nowhere. Through the year, there will be, of course, stock opportunities on a bottom-up basis, which I hope I will find. But by and large, is this a good time to be holding some cash? Yes, absolutely. Is one should take the profits where valuations appear to be disproportionately high or the story seems to be stretched. I think too much of a good thing is never a good thing.
Too much of good thing. I look at the stock price of a Paytm. I look at the stock price of metals. I look at IT. I mean, there is bad news. There are bargains available.
Yes, there are bargains available for sure. I think if you look at the upstream chemical sector, after the peak of earnings in 2021, last 1.5 years, you've seen a significant amount of decline in revenue and decline in margins led by inventory liquidation from the customers globally. And you've seen slowdown of demand as well. So I think, yes, you're right. There are bargains available within the financial sector also. There are bargains available. There are other places where one can look for bargains. So yes. I mean, on a bottom-up basis, there will always be opportunities. That is the nature of the market. But if I think about a portfolio allocation, and let's say I want to hold my equity exposure, just taking a number out of the hat, not a reflection of how I think about it personally. But let's say for an investor, 60% is the percentage allocation towards equity that he wants. At this point in time, my advice would be go down to 50 or 48 or something like that and hold the cash. Nothing wrong with that. If the market goes up, you still have half your money in stocks and you benefit from that. But the likelihood that you will get a better entry point is quite high if you wish to take cash calls. There is another school of thought which says that cash calls don't make sense and one should always be fully invested, which is fine. Even then, a mere portfolio reallocation and right sizing your equity exposure will force you to sell if you've been fully invested from that perspective. So I think yes, that's the right thing to do.
When will you use that 15% cash? On a 15% decline or a more...
The vengeance in 2024. As we stand today in middle of February, our expectation now is that rate cuts have been pushed out by another 2 or 3 months. So, the market evolves, fundamentals evolves, story evolves. So we'll see. I feel things are expensive today, so I'm sitting on cash. I might change my mind, based on how the data evolves. So I don't think anything is cast in stone. And it won't be profitable for anyone to believe that the market will go down 15% and that's when you put everything in. I may find bottom-up opportunities which are interesting, which I'll force my hand and I use up this cash. I think it's an evolution and one has to watch things on a daily basis and remain flexible.
Ashwini, that's exactly what I was going to ask. Forget the cash. What's the shopping list looking like? You did mention bottom-up stories, but is it going to be more of the same, whatever has worked in the year gone by, or newer themes that you're looking at?
So I'm actually quite excited by the whole chemical space where the earnings cycle seems to have bottomed out. I continue to believe in pharmaceuticals, where I think the pricing environment and the demand environment are reasonably solid. I think IT services might be a place to hide. I don't own it personally, but I think from a risk return perspective, in a benchmark portfolio in IT services, holdings might actually do reasonably okay. I don't think there's a lot of absolute gain to be made there, but on a relative basis, they might hold up. So there are pockets to own, even on a bottom-up basis across export-oriented units, domestic demand-oriented consumer staples names. There are bottom-up opportunities which I find quite exciting.
Okay, Ashwini, final question. If one looks at the big theme in India, it is consumer.
Yes.
the street is divided on this K-shape recovery or this V-shape recovery. There are data points which say that the recovery is fractured. There are data points which say the recovery is very urban and luxury focused. Do you see that changing as the economy now normalizes?
I hope so, Nikunj. I really hope so. I think it's the narrative that only the rich are doing well is not very good for a country like India, where 95, 97% of the people are not being able to participate in the consumer euphoria. So I think it is very important that the down leg of the K, if for the middle and the lower layers of the pyramid. I also think that the expenditure on the government capex that's been going on will finally get released, hopefully in the next few 6 weeks to the end of the financial year, and will ease the liquidity, and that will hopefully help some consumption. But my hope is that the consumption will become more even than uneven. Over the last 1.5 years, it's all been about premium and luxury, and I don't think that's the right narrative for a country like India. So I'm really hoping that it will be more even going ahead. Certainly, if I look at some of the opportunities in the market, I had mentioned consumer staples earlier. I think on a relative basis, select stocks there are starting to look attractive, and I would venture there. I mean, I do have some positions there already, where raw material prices are benign. The margin outlook is reasonably constructive, and demand factor is missing, and I hope that will kick in.
Interesting. Ashwini, always good to have you on the show and chat with you.
Thanks
for taking the time out.
Thank you.
Okay, let's just move on. Let's just revisit what the market is now settling in at and where we're currently at. We have started off on a bit of a back foot. We're down now 1% or so, equating to about 200 odd points in the Nifty futures. Gujarat Gas, LTTS, Oro Pharma, Oracle Finance, Emphasis, these are your weaklings from within the broader end of the market, and clearly within the large caps as well. It's IT which is weighing heavy. So TechM, Infi, Wipro, LTIM, they're all a pack of red right now. ICICI Bank, Kotak, Tata Steel, L&T, HDFC Bank, which is now actually around 1360 thereabouts. Let's just see. Yeah, that's where the stock is. So it's getting pretty close to its 2022 lows, which is when the merger got announced and the stock did begin its fall. There's IndusInd Bank as well. That's also lower currently in trade. So banks, IT, blue chips, they're all weighing heavy as we speak right now. But here's Sandeep Tandon from Quant Mutual Fund sharing his investment mantra, saying he remains constructive on PSUs irrespective of the run-up that they've had.
And obviously PSU qualify as a value thesis right from September 2021. So it'll not be, we were relatively, as compared to somebody is looking at the top, we are very early in identifying that inflection point, and I've been very bullish for last more than 2 years now in this space. So we remain very constructive. If you look at the larger picture, we are looking for the PSUs. Okay, neither we get too complacent about the move which we happened very recently, nor we get too tense about what happened in last 2 or 3 trading change. Okay, if I have to look out about the perception analytics point of view, for the perception for India has changed. Okay, so I always talk about look at multidimensional thinking rather than just looking at the valuation as a number. Okay, valuation as a number will give you only limited answer. When you look at the larger pieces, how the sentiment or the perception is getting built globally about India, how is the global liquidity situation, and if you look at in tandem, then answer is very different. Okay, and I always talked about that growth as a cycle which peaked out in September 2021, which lasted for a decade, more than like started in or rally from August 2012. And if even 20-30% of money shift from growth towards value, there will be big up move which we can continue in value stock, and that's a thesis which we are playing, and I think it's a decadal call. It's not a just 1 quarter or 1 year call which we are playing out. And obviously the bigger call is value, not PSU, and within that PSU fit the bill perfectly. So it is apt to for us to say and look at the changes which is happening. Okay, look at from the governance point of view, changes happening in the public sector, the capital allocation which has been a very big concern in the past, that has settling down. Okay, people used to look at the political outcome, these are the company which was vulnerable on that thing. That has strengthened a lot. Okay, so if you look at multiple data points, okay, it is all supporting a largely a very constructive thesis. Okay, and still grossly underwrote. Okay, now if you really look at, if I have to address this point of a very recent correction, I think one of the channel I talked about, when your conviction is not there, okay, like majority of because of just to manage their underperformance. Okay, the underperformance was very meaningful. Just to manage that, when you buy these names, okay, obviously then conviction is not there. When first round of correction happened, and that's the reason I have seen the massive sell-off comes. People vomit immediately because it is not coming from their conviction. It is the compulsory trade which they are participating. Though when conviction is not there, when any jolt comes to the market, you give up first. And this is what exactly happening in the market, and it's valid for majority of the mass large family office investor, ultra HNI, who have been never believer of this thesis. Okay, so see, we as a house, we always believe that we are unconstrained fund house. Okay, if we see opportunity in growth of particular sector, we will participate. And when we are seeing a decadal opportunity coming in these names, I will definitely participate, and we don't get disturbed. What happened very recently. Obviously, some of the froth was there. A lot of people have left out feeling they just participating irrespective, and some of the uh, I say illiquid names also rallied, where float was on the lower side, but valuation was not justified. Those stocks also rallied. It's bound to correct. Obviously, correction in those names will be much deeper.
At the recently concluded GBS, you also had the Power and Renewable Energy Minister talking about how the sector is really gearing up for capacities to meet the growing electricity demand, given that there's been a huge surge as well in economic growth. As a space as well, a lot of stocks within this sector have fired up. What's your take on the power stocks?
So power or energy as a thesis, we remain very constructive for a while. We have been talking about for more than a year now. Okay, this is the opportunity which we talk about, both in the not only in public sector, even in the private sector. There's a great opportunity. And again, this is also, if I look at much larger thesis about renewables coming into picture or new age energy, if I have to talk about, I think then this thesis can last even again for a decadal perspective. It's another very big call. We believe all power company should be given the shortage of the day.
All right, let's get a move on then. And for now, we're holding out. It's down 0.7%, 600 points out for the Sensex as we speak. In comparison, the small cap end of the market is far better off, while the mid caps have pretty much succumbed to the same kind of fall as the frontliners. But it's also focused on the primary markets today, and we've got a whole host of listings actually that we're anticipating. Let's get in Sharad, who joins in with the updates. There's going to be Rashi Peripherals, Jana, as well as Capital SFB. Sharad?
Well, yes, three main board listings are coming on the bourses today. The first one being Rashi Peripherals. It's an 5%. Now, of course, post-listing in the valuation, if you look at it, is expected to range between 13 to 17 times, and all these valuations are calculated on a forward 12-month basis. Also, two other banks would be coming in foray, which they'll be coming in for listing. Both are small finance bank. The first one being Capital Small Finance Bank. The IPO price is at 468. Subscription was 4.2 times, and the grey market premium suggests a listing gain of roughly 10 to 15%. It's expected to be slightly on the flattish side. Also, if you look at the Jana Small Finance Bank, the IPO price is at 414 rupees per share. But over here, if you look at the subscription numbers, that's on the higher side. Almost 19.4 times the subscription was there, and the grey market premium currently is ranging between 28 to 32 rupees, and it's expected that there would be a 7 to 10% gains expected. So lukewarm gains is expected for both the small finance banks, but on the higher side, Rashi Peripherals is expected to command more than 15 to 20% listing gains. And do remember, the last 2 to 3 days of the trading sessions, the grey market premiums did evaporate because of the corrections which were happening in the broader space as well.
Okay, that's that on the primary market listings. But let me welcome on board Shikhar Agarwal, the chairman at BLSE Services and joint MD BLS International on the show right now. Shikhar, hi, morning. Good to have you on the show. You've come out with the results for the first time since listing, but sequentially there's been a drop in the revenue, right, by 11%. What was the reason for the same, and how do you think your volume growth is going to pan out for FY25?
See, if you see our this quarter numbers in BLSE Services, there has been a growth compared to similar quarter last year. So definitely, and if you see even the EBITDA has grown to 10.31 crore, which is a growth of around 15% compared to similar quarter last year. This company has been growing BLSE Services. Now, even after the IPO, our plans are to help to spend the money on inorganic acquisition. If you see, we have acquired two companies in this respect, Zero Mass and iData. And now we want to acquire more companies in the e-governance sector. So definitely, we see more growth coming in. We are working with multiple banks. When we started, we only started working with major PSU banks like State Bank of India. Eventually, we started working with Bank of Baroda. A lot of private sector banks like HDFC. Now we work with 15 banks across India. Our network is of now 90,000 plus centers. Around 4 lakh people are coming in every day. Even our EBITDA margins are improving. If you see, our EBITDA margins are now 14.39% in BLSE Services compared to 12.91% last year. So definitely we see an improvement, and the next few quarters also we see this improvement continuing.
Morning. So given that you were alluding to acquisitions, etc.
Odd crores of cash on the books. I think in the e-services segment also, we have sizable cash. I need to check the exact figures. But we have been doing due diligence continuously on multiple companies. And now after the IPO, we're having the cash on the books. We are definitely now geared up to spend that money. So we are constantly doing due diligence. As and when things get finalized, we will be announcing that.
Okay. Let's also talk about your other financial metrics, because your operating margins have improved due to the change in product mix. They've gone past that mark of 15%. For FY25, can we see a higher margin guidance? If so, what would drive that?
See, in our parent company also, BLS International, we now are doing margins of upwards of 20%, whereas in the last couple of years, we did a margin of 15% odd. In this BLSE Services, which is a 5-6-year-old company, we have now already increased the margin from 13% that was happening last year to now 14.4%. And now going forward also, our objective is always as a company, to rationalize the expenses, grow the margin. So we definitely expect, in the next few years, margins improving as, the assisted e-services, as we cross-sell and upsell more products, more services to our existing customer base, definitely there will be an increase in profitability.
And give us a sense as to what the outlook is when it comes to bidding inquiries for e-governance services, especially on the government tenders.
See, when we started working with one of the state governments in India. Now we are working with different governments like UP, West Bengal, Rajasthan, Karnataka. All these governments.
Say in terms of new BFSI clients are getting added up, what could be the extension of it? As in, from where would you get these new clients?
See, what is happening is, to get banking to the rural part, semi-urban part of India, RBI had come long back with the policy of business correspondent, and that has been a success. It has been phenomenal, at very less cost for the banks. We are operating centers across different geographies. So first is the existing customer that we have. For example, SBI, they are also expanding their reach into different states. They are asking us to open more codes every year. Then more products are being added every month. For example, certain services which were being directly done by the bank are now added to our kitty. So customers can avail those services from our kitty. We are at the same time even adding more banks. So I think growth is coming from our existing banks, wherein we are increasing the network, adding more products, adding newer banks. First we were focused on public sector banks. Now we are focused on private sector banks. Banks are even telling us to do banking, KYC, etc. So, more services are being added. We are now, people can come and pay, their loan, their monthly loan installment, they can pay at our center. So a lot of things are added every month to our kitty.
So much for taking time out. Good to have you on board, giving us a sense as to how business is shaping up. So yes, more acquisitions and margin improvement expected. The stock price, by the way, is up and away close to the highest point of the trading day. That's BLSE Services, notching up higher by nearly 9%. All right, let's move on to big voices then at the Global Business Summit. And Ace American investor and Bridgewater Associates chief Ray Dalio is bullish on India. In conversation with Nikunj, he said that the dynamic of the world order is now shifting towards India. Listen in.
Based on your internal models, where does India stack up From fragile 5, Mr. Dalio, India is now top 5 in the world.
In my book, and again called The Changing World Order, we use statistics that go back mostly for many, many, many years to predict the next 10 years growth rate. India is projected to have the fastest growth rate in the world of any sizable economy. And that's why the basics, what are the basics? You're seeing a combination of the development of a middle class. And with that development, you're seeing vast improvement, people to be very productive. At the same time, measurements like what is the cost of an educated person? This is across societies.
Right, okay, that's an exclusive conversation with none other than Ray Dalio. In the meantime, let's move forward and let's welcome on board Panu Chopra, the founder and MD at RateGain Travel Technologies, joining us on the show right now. Panu, hi, morning. Good to have you on the show. It's been a steady Q3 for you as I look at it. You've seen a jump coming in from Adara as well on a year-on-year basis. Are you on track for that double, revenue mark that you set for in the next 3 years?
Yeah, so thanks for having me on the show. Yes, we had a very robust quarter again. And I'd like to remind you, we are now at 82% growth for the first 9 months and far exceeding the guidance that we had given for the beginning of the year, which was around 55 to 57%, which we revised upwardly to about 65% now. So very pleased with the results, and given how we have performed and delivered on our promises after our IPO, I feel pretty good about the promise and the target that we've set up for the next 3 years as well.
Why last 3 months have been extraordinarily good for you? I mean, if I look at the last year, which is FY23, and compare that with FY24, you're firing full cylinders. What has changed in between a year?
So, as you know, Nikunj, one of our growth drivers has been this marquee acquisition that we did of Adara, which sort of completes our integrated suite. And our vision is to have this one integrated suite that allows our customers to acquire guests, retain them, and engage with them, and have a wallet share expansion. So Adara has been instrumental in building the acquisition funnel for our customers, and it has the complete suite is very, very compelling, and as a result of which you see the growth that you see.
How much is coming from, let's say, the original organic business, and how much is coming from Adara and the new organic business? I mean, could you just give us a breakup?
Yeah, so organically, we're at about 30% now.
Okay. Now, do you see this kind of a run rate will continue for FY26 also? Because FY25, it's obvious that you will continue to grow. But FY26, can you sustain this kind of a momentum, or you'll have to acquire something else to build on it?
So what we've guided the market, Nikunj, is like over the next 3 years, we look to delivering on whatever we promise. I feel pretty good about it. If you look at sort of the overall macro indicators as well, there is very robust demand in travel. People's attitudes towards travel has changed. When you come to discretionary spend, travel is on top of their list. So I feel pretty good with the macro factors aligning that we should be able to come on good on the promise.
Right. And morning, Banu, given the fact that even your margin improvement has continued in the quarter gone by, given that you're so optimistic about growth down the line, doubling revenues over the next 3 years, what can we expect when it comes to your margin trajectory?
Yeah, similarly on our margins also, when we came at the time of the IPO, we had talked about going from 8% to 20% over the next 5 years. So again, we are far exceeding that target. We are already have achieved the 20% margin in year.
Oops, we seem to have, I think, snapped that line, just getting in a view on the overall financials and what the margin trajectory is. But nonetheless, The management alluding to the fact that Adara's acquisition has been critical to bolstering growth. 82% is what they've seen in the last 9 months, and they will double revenues over the next 3 years. All right, what else is buzzing away then in the market? Let's take you. Okay, Mr. Bhanu, thanks for rejoining us. There was a bit of an issue. You were talking about your margins. Give us levels.
Yeah, so we currently at 20%, and what I talked about is when he came at the time of the IPO, we talked about going from 8% to 20% in 5 years. So we sort of exceeded that target. From here,
Is expected for M&M's quarter 3 performance. Let's break down what the street is penciling in. Revenue is expected to grow by 17% on a year-on-year basis and 4% sequentially to come in at 25,320 odd crore rupees. Margins, however, on the other hand, are expected to remain rather flat on a year-on-year basis. But on the sequential basis, when you look at margins, they're expected to improve on the back of the operating leverage as well. Now, when we look at profitability, PAT is expected to grow 23% on a year-on-year basis, but sequentially, it is expected to fall 23%. So we'll see how these numbers pan out for M&M. When we talk about volumes, the auto volumes expected to be up 20% on a year-on-year basis, and tractor volumes expected to be down 4% on an annualized basis. What are the factors at play over here? The strong volume growth in autos on the back of improving supply chain will be one key factor to watch out for. Tractors have declined on a high base of last year and uneven rainfall, so the tractor segment could be in a little bit of a trouble on the back of this. And better net pricing will be mostly offset by adverse mix and higher marketing spends that came in quarter 3 as well. And also what's key to watch out for will be any outlook on the tractor demand that the management will give, and any guidance cut for the tractor industry growth on the back of the factors that we just spoke about, and any open booking in the SUV segment. So well, the street will be watching out for all of this, but a rather decent set expected from M&M for their quarter 3 performance.
Okay, that's M&M, which is slated to come out with its numbers. But look at Oro Pharma. They've got a Form 483, and there are analysts are saying that they believe observations 1, 2 are pretty severe. And here's what that Form 483 note actually reads in terms of observations. The first observation is that they need to take steps to prevent contamination of sterile drugs, which is not established. The second observation is that the laboratory records do not include complete data derived from all tests, examinations, and assay. The kind of necessary to assure compliance with established specifications and standards. So in that sense, a little grave, the observations that the Form 483 entails for Oro Pharma, and you can see that stock price reaction as well.
Time and again, Indian companies have failed to live up to their expectations. I mean, why do these problems happen again and again? My limited point is that one side we are talking about manufacturing, and we are talking about, Apple phones being made in India. So we are moving up in the supply chain. Pharma is nothing else. Ultimately, it's chemical manufacturing. It's sophisticated chemical manufacturing. Sterile drug is something which is injectable, which goes in your body, which needs supreme attention. So time and again, why is that, some of the pharma companies repeatedly, they keep on getting these. US pharma industry has multiple suppliers, but right now the US pharma industry is desperate for a sensible and a stable supply. Too many supply chains have got disrupted after COVID. There's literally shortage of antibiotics and injectables in US, and US is trying really to bring and speed up their alliance with Indian manufacturers. Yet some of the companies, they always fail to do it. Look at Wockhardt, they've never got a clearance. Aurobindo time and again keeps on going into it. Time and again you see a Lupin and Cipla coming into it. Okay, there you go guys, it's not been a great day of listing. Jana SFB, Capital SFB, 2 small finance banks, and they go Rashi Peripherals. I track Jana. So all I can say is that this is one stock where if you really think about it, we've known Ajay for a while now. So it's very big for Ajay and for any promoter for that matter. Why just Ajay? I mean, for all three of them to see this kind of a change and this kind of growth happening. So it's a big day. It's a very big day in terms of where things are moving for them. It may not be like cracker of a listing which everybody anticipated and expected, but that's markets for you, which always will trouble you and which always will puzzle you.
But it's been a Pretty decent listing for Rashi Peripherals, actually. Remember, it's an information and communication technology distributor, and expectations were riding high that that would have been a stellar listing, and I think it listed at close to a 20% premium. What you're looking at on your screens right now is currently Capital Small Finance Bank, a muted debut, and I think that's on expected lines. Remember, it received a pretty subdued response. So yes, the rates will just come up for you on your screen. Financial services provider as well, and it was a little bit aggressively priced. Maybe 421 is where it's settling at, and it's been a little bit muted as well for Jana Small Finance Bank. A bit of a muted debut on D Street. But let's keep it going then and put the spotlight next up and talk a little bit more about what the outlook is when it comes to Senco Gold. Came out with their quarterly performance. What is the outlook when it comes to revenue, jewelry demand? We've got Suvankar Sen, who's the managing director and CEO, now joining in. Along with him, there's Sanjay Banka, the CFO, I believe, at Senco Gold. Thank you so much for taking time out. Let's just talk a little bit more about what has been the growth driver, how the months of Jan and Feb have panned out, sir, so far.
Yeah, hi.
Yes.
So we have declared our result yesterday, and YOY we have grown 23% at retail, and overall, including other sales, we have grown 26%. Clearly, the growth lever has been the same store sales growth. So, like we have reported on 17% same store sales growth, which is coming out of our existing stores. And we have rolled out almost 19 stores, 15 own store and 4 franchisee store. So we are going deep. Secondly, the stud ratio is very important to improve the profitability. And as the industry rate is almost 15%, while some of our peers are clocking almost 25%. So stud ratio is second. And third is that ASP and ATV. So the ASP and ATV, that also we are maintaining in the range of 45,000 and 65,000. So these are 3-4 factors. The footfall has increased. We have also launched recently a new collection like CRM collection, which has gone quite well with the market. And across other markets, we are trying to improve the stud ratio. So if we look at, as we reported earlier, the stud ratio in own store is in the range of 13% as against the average of 11%. So overall, we are very happy, and even the gross margins and EBITDA margin has also improved this time quite considerably in line with our earlier last year 9 months trend. So for the full year, we are looking forward to have the same stud ratio and EBITDA margin, which are in line with our earlier guidance.
Sanjay, what I also wanted to understand was your margin trajectory, because they've been subdued for the last few quarters. Where do you see them headed, and what kind of growth rate are you expecting for the full year next one?
So we've already reported 26% growth, and quarter 3 is over, and now we are in the month of February. So we are quite confident that will be the growth after taking the quarter 4 number should be in the range of 22 to 25% overall. As regard margins are concerned, in quarter 1 and quarter 2, it was subdued, the 7% range, which was our earlier guidance. So versus last year 7 months and versus last year 9 months, and this year 9 months, we are almost in the line. That's what we guided the market, that for the current year, EBITDA will be slightly lower than last year, but as the competitive intensity is increasing, and we are now investing more in our growth, in our manpower and in markets, and also we have to give more and more offers to the customer as we are entering into the new markets.
So Ankar, Nikunj joining in, so nice to connect with you. I distinctly remember when we spoke ahead of the IPO, you actually wanted to go ahead and do the IPO because you wanted to expand without raising too much of debt. So now that you've gone public and it's been almost 2 quarters now, what has happened on the expansion plan, Suvankar?
The expansion plans continue to remain as it is. If you look at our historical past, every year we've been able to open around 18 to 20 stores in a sustainable manner with a mixture of company-owned, company-operated stores and franchisees. So that would continue to remain. We will continue to focus on our tier 2, 3, 4 expansion. and creating a hubs in the bigger cities. So that is how it is. We have multiple formats, be it own store or franchisee. We are opening new formats in the form of our Everlight, which is the lightweight everyday wear jewelry store. We got Cines as a brand that we have launched, in which we are focusing on lab-grown diamonds. So therefore, through the various means and methods and the locations, ultimately the vision is that in whichever way, whether it is a 2,000-3,000 square feet
to the jewelry buyer now. The migration from real diamond to, let's say, lab-made diamond. I'm not using the word artificial diamond, but they are called as lab-made diamonds. Is that impacting your business also?
Very honestly speaking, it is not impacting the business, because if you look at the overall ratio of gold jewelry and diamond jewelry in the whole country, the share of diamond jewelry sales is only in the range of 15 to 20% all in all. If we go down to the smaller towns, people there are still getting used to buying diamond jewelry, getting into the habit of buying diamond jewelry. So we believe that with the gold prices on the upward trend, the possibility of selling more and more diamond jewelry, which is made with 14 karat or 18 karat gold, which makes the price of gold lower than a 22 karat gold. And all of them will be hallmark. So there is no question on the quality and the price that you're charging for it. So that will be in an upward trend. Now, when it comes to lab grown, only when a buyer has gone through the journey of buying natural diamonds and there is an aspiration to buy bigger size natural diamonds, that is when, as an option, or as I wouldn't say a substitute but a complementary, because lab grown diamonds would be more from a fashion perspective and lesser from an investment perspective, they would start exploring on buying occasion to occasion, variety of shapes, sizes. So that is how the scope of lab grown will remain, and both will continue to stay. So it is very early days. Right now, if you look at our diamond jewelry growth, we are growing in terms of 40% in terms of value and 27% in terms of volume, which itself is a very good signal. And it is with the gold prices that are going up, it is helping people to compare and say, "Arey, diamond jewelry is as competitive and affordable as a gold jewelry. So let us go for diamond jewelry." That's the scene that is happening at the ground level.
All right. And give us a sense as to what the outlook is then.
Very hopeful and positive that we will be growing at an upward of 20%, which is because we are already growing at 26%. And
I'm just wondering, for Valentine's Day, is there any sort of a spike in the demand for jewelry?
Yes, what's happening is now India, along with your traditional events are there, like Dhanteras and Akshaya Tritiya, with the new generation coming in, people are very excited. We've got our own Valentine's Day offer running for the last 2-3 weeks. And the best part is, it's not only the young generation who are celebrating Valentine's Day. There are people who are from the maybe a little more senior, the millennials or the senior generation. They are also coming to the store trying to gift for their wives. So it's really a very nice, warm occasion, and we are seeing a good response, especially in terms of diamond jewelry, because diamond is what stands for love, and that is what we are trying to push and promote.
Still more precious, but we'll have that discussion some other day. Both of you, thank you so much for taking the time out and joining in.
Thank you very much. Thank you.
Okay, let's take a very quick break. Nalco, that's your big star performer today. It's a 6% uptick that Nalco is seeing after very, very positive numbers. Oro, after ET now got access to the Form 483, where the first and the second observations are quite critical. It's a downtick, but a bit of a respite from those lows as well. Look at for HDFC Bank, that's already skirting at those 2022 low levels. I think July 2022, to be precise. It's already at 1370 odd level as we speak right now. We'll take a break, come right back. Lots more lined up.